Welcome to Stocks Review. Today we are going to take a look at Disney. Stock ticker symbol DIS. It is headquartered in the USA and service regions all around the world. The service region may give us a clue of the company's overall stability and long-term growth potential. It has a market cap of $203 billion and is considered a mega cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the communication services sector and entertainment industry. The Walt Disney Company operates as an entertainment company worldwide. It operates through two segments, Disney Media and Entertainment Distribution, and Disney Parks, Experiences, and Products. It engages in the film and episodic television content production and distribution activities, as well as operates television broadcast networks under the ABC, Disney, ESPN, Freeform, FX, Fox, National Geographic, and Star brands, and studios that produces motion pictures under the Walt Disney Pictures, 20th Century Studios, Marvel, Lucasfilm, Pixar, and Searchlight Pictures banners. It also offers direct-to-consumer streaming services through Disney+, Disney+ Hotstar, ESPN+, Hulu, and Star Plus and licensing of film and television content. In addition, the company operates theme parks, resorts and cruise line all over the world. Further, it sells branded merchandise through retail, online, and wholesale businesses, and develops and publishes books, comic books, and magazines. In short, it is a diversified global entertainment business. Its price has been quite stagnant recently. It has a 5-year price return of 1.6% and lags the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. It has a 5-year compound annual revenue growth rate of 3.9%. The revenue growth is unstable and the revenue trend looks ordinary. The revenue trend is important as growing companies often have sales go up first followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. The net income has just turned positive recently. The net income trend looks like it is on a track to recovery. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been issuing more shares in the recent years probably for funding its growth. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It has just slashed its dividend recently. That is not a good sign. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of Disney is quite good and slightly outperforms the historical performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly with a slight decline in growth as time goes by. Disney has a 37-year total return of 10,333% with a 37-year compound annual growth rate of 13.35%. If you had $1,000 invested 37 years ago, you would have $103,330 now. Currently, the price is at around 111.6 with a 52-week high at 189 and 52-week low at 111. It is near the lower end of its 52-week range. It has a P/E ratio of 64.6 and forward P/E ratio of 25.6. It has a cash position of $14.4 billion and long-term liabilities of around $69.7 billion. The ratio of cash, debt and market cap may help us evaluate the default or bankruptcy risk and what percent of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. Disney is considered a wide moat company according to Morningstar's rating. Now, about the future projection. Currently the margin is 4.2% and future margin after 5 years is expected to be 13.5%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. It has a 5-year forecast revenue compound annual growth rate of 11% and 5-year forecast EPS compound annual growth rate of 16.4%. The near-term growth is expected to be good. It has more beats than miss of analyst consensus EPS estimates in the last 4 quarters. That's not an impressive result. The overall analyst recommendation rating is a buy with trend shifting towards hold recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 21 analyst 1-year price targets, the range is 140 to 229 with an average price of 185, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 175 with an upside of 57%. If we run the DCF terminal EBITDA model, the fair price is 128.5 with an upside of 15%. If we run the DCF terminal revenue model, the fair price is 149.5 with an upside of 34%. Now we compare Disney with U.S. Treasuries and SPY. It cannot be emphasized more that the U.S. 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 2.88%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY is at around 10%. The SPY has an average forward PE around 17.6 now. Disney has a dividend plus 10-year growth forecast plus shares buyback yield at 3.9% and a forward PE around 25.6. We have to be cautious that this is just a rough prediction of Disney's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like Disney is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all the information above to give us an overall impression of Disney. In summary, Disney is a mega-cap stable company with small growth and wide moat, and probably overvalued now. If Disney is able to maintain its margin with a steady growth, then it may be a fair play long term. Now that's a review for Disney stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.